Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Ray Heung, your host for this episode of Through the Noise. And today I'm very happy to join by Manpreet Gill, our CIO for the AMEE at the CIO office also. Now, in the outlook that we have stated for the second half of this year, Manpreet, I think you have discussed several pivot points to monitor as we go through, the rest of the year. Now, obviously, a month have passed, and it seems like ages for us. So, which ones you think are still worth paying attention to at the moment?
Hi, Ray. Indeed, it's been an eventful few weeks since our second half outlook. But of the pivot points that we had laid out at the time, I think energy prices and central bank policy are really dominating the narrative. Now, renewed Middle East conflict escalation did result in oil prices rising briefly above $90 per barrel, which of course reignited concerns over their inflationary impact. But we continue to hold the view that prices will remain largely range-bound within the $70 to $90 range on WTI, and any short-lived moves above this range are likely to incentivize some form of de-escalation, mainly to avoid a bigger inflation shock. Now, a more notable development in our view in recent months has been the rise in real bond yields. So in other words, net of inflation bond yields. Since mid-May, the real 10-year US bond yield has risen towards 2.5% from what were earlier levels just below 2%. And obviously what we're watching here is that an extension of this move above 2.5%, which was the prior peak in 2023, would end up resulting in the highest real yield since 2008. That, of course, holding the potential to trigger a negative reaction in equities. Got growing Fed policy uncertainty under Chair Walsh and persistent concerns about developed market debt levels are most probably some of the factors that are behind this move higher in real bond yields. However, we do believe today's soft landing environment will extend as the Fed avoids actual rate hikes, which in turn, of course, helps cap those real yields. Inflation, of course, remains a risk worth monitoring, but contained oil price inflation expectations, in our view, remain encouraging.
Thank you, Manpreet. I think you have definitely set the context for us right now. So, do you expect the optimism in equities to persist right now? Are there any risks to be particularly that we need to be mindful of?
Well, yes, at the moment, we certainly are keeping our optimism on equities. So we're remaining overweight at a global equities level. But as we did lay out in our second half outlook, the short-term path could be a relatively bumpy one. Now, the trade-offs here are best captured by our quantitative stock bond model. Now, this model, of course, remains overweight equities, but the magnitude of that optimism has reduced somewhat. Fundamentals remain the key support for stocks, and its technicals and valuation are the factors that have turned a little bit less supportive. And if you think about it, this matches the wider narrative of stronger equity earnings growth fundamentals being the long-term positive, but these, of course, balanced in the short term against that rise in real bond yields and short-term worries focused around energy prices, central bank policies, and AI. But on balance, we do expect optimism to ultimately persist, and the main factor for that is, those strong earnings growth fundamentals. But of course, we just think that optimism will come with a little bit of a higher level of volatility. So from a regional perspective, that's why we're retaining our overweight views on the US and Asia ex-Japan regions in foundation portfolios, and would consider a strategy of adding to these preferred markets on pullbacks. Now, on your the other sort of point to keep in mind here is not just a regional approach. I think part of the way we deal with this, with heightened volatility risk, is to broaden sector exposure via opportunistic allocations. So on that front, we've upgraded this month US financials, the sector, to an overweight, and that leaves us, of course, for a preference for the financial sector now across the US, Euro area, and Japan equity markets. The main driver of this is higher bond yields. That, of course, in turn driving a positive outcome on net interest margins across most regions. But in the US, it helps, of course, to have the active M&A and IPO environment as well. Meanwhile, we do also retain our US communication services sector opportunistic idea with the strength in earnings growth expected to outweigh any lingering doubts over the pace of AI capex monetization. Finally, on your point on risk to monitor, if we look further into the second half of the year, it's really the November US midterm election. That's where we'd see a volatility risk worth monitoring. Historically, since 1990, the S&P 500 has faced an average drawdown of approximately 16% during US midterm election years. But the range around that, of course, is pretty wide, ranging from 7.3% all the way to 33% drawdowns. This year, the fact that the S&P 500 has already faced about a 9% drawdown from late Jan to early March means we're reluctant to forecast another similar episode in the coming months. However, this context does argue for ensuring portfolios are prepared for higher than usual volatility.
I see. Now, going back to your earlier point on when you were talking about high real bond yields, do you think that is an opportunity for investors right now to lock in this attractive level of yield?
We do. In fact, to bonds overall, we're actually taking a bit of a glass half full approach. And this month, we're actually raising bonds to a core holding. Now, we acknowledge that rising real bond yields are a potential risk worth monitoring. But in our view, the lack of follow through on actual rate hikes by most central banks will end up ultimately diffusing the risk from real bond yields. So, from a bond investor perspective, from a yield investor's perspective, that argues for using the current rise in bond yields to lock in an attractive yield, both in nominal as well as real terms. But like with all things, the detail is important here. So within bonds, our preference for corporate and EM bonds over G3 government bonds remains unchanged. The yield premiums undoubtedly a little bit small by historical standards, but we believe still high credit quality continues to justify this elevated valuation. Our overweight, of course, remains focused on EM US dollar bonds, and this reflects both strong fiscal fundamentals, but also somewhat attractive relative value. US investment grade bonds might face temporary headwinds from significant hyperscaler debt supply, but in our view, this reflects a temporary supply influx rather than any worsening of fundamental credit quality. The final point, and perhaps this is the most important thing here, right? The final point is that maintaining short duration in US dollar bond portfolios is key to navigating this environment. The rise in the 10-year bond yield, particularly in real terms, as we discussed earlier, reinforces the risk of elevated volatility from any excessive exposure to long maturity bonds. At the end of the day, we still believe that the gap between the short and long maturity bonds on offer today just doesn't compensate investors adequately for the risk they're taking on. So while we're fans of locking in the risk, we think one of the most important decisions is to keep a preference for short duration bonds in the 3 to 5 year range.
I see. Thank you, Manpreet. But I can't just let you go without answering the question on gold. So what do we expect gold to do again this backdrop right now?
Indeed, we can't have a conversation about multi-asset classes without gold. This month, we've actually trimmed our exposure to gold to a core holding from what was an overweight earlier. And look, there are several factors at play here. Undoubtedly, prices are showing signs of stability in recent weeks, but the higher bond yields we've been discussing in previous questions, they're also setting a much higher bar for the asset class to beat. So we're positive on gold prices in absolute terms. We still expect prices to move to about $4,600 over the next 6 to 12 months. So we'd still see current market conditions as attractive to accumulate gold in under-allocated portfolios. However, given what we're seeing on bond yields, we just think the pace of the price rebound is likely to be relatively slower and shallower than what we expected prior, given the higher bar set by those bond yields.
I see. Thank you, Manpreet. I think in closing, let me try to summarize what we have been discussing just now. I think number one is that we remain constructive on risk asset, given the supportive growth and earnings fundamental in particular. But the ride for this is likely to be fairly bumpy. And so we stay on overweight on equities, and our regional preferences is through the US as well as Asia ex-Japan. Number two is that we did upgrade bonds back to neutral. We think that right now the high real bond yields should argue for a lock-in in income. And in the bond universe, we prefer emerging market US dollar bonds. Finally, on gold, it's reduced to a neutral core holding position, as we believe the elevated bond yields right now raises the bar for gold to see a quick price recovery. That's all we have for this week. The latest global market outlook shall be already in your inbox. Please take a look. And thank you all for listening into this episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.